On the 20th of September, your age pension goes up by $36.80 a fortnight if you are single, and $55.60 combined if you are a couple. Every channel in the country is telling you that half. Almost nobody is telling you the other half on exactly the same day. Deeming rates go up too. And for pensioners with savings, that quietly takes money back. For some people, it takes back more than the rise gives. There is a specific dollar figure where you cross from better off to worse off, and I've worked it out for both singles and couples. Let's go through both halves of what is actually happening on the 20th. Before we start, hit subscribe and tell me in the comments which state you are watching from. It helps me know what to cover next. From the 20th of September, the maximum single age pension rises to $1,237.70 a fortnight, an increase of $36.80. For a couple, the combined maximum rises to $1,866 a fortnight, up $55.60 between them. If you want the breakdown, the basic rate accounts for $35.10 of that single increase, the pension supplement adds $1.70, and the energy supplement doesn't move. That's the number in every headline, and for a large number of Australian pensioners it is exactly what lands. Now the half nobody is putting in a thumbnail. On the same day, the deeming rates rise by half a percentage point each. The lower rate goes from 1.25% to 1.75%. The upper rate goes from 3.25% to 3.75%. The thresholds where one becomes the other do not change. They stay at $66,800 for a single person and $110,600 for a couple. If you're new to deeming, here's the 30-second version, because everything that follows depends on it. Centrelink does not count what your savings actually earn. It assumes a rate of return on your financial assets, your bank accounts, term deposits, shares, managed funds and account-based pensions, and counts that assumed figure as income under the income test. Your term deposit could be paying you almost nothing, and Centrelink will still assess you as having earned whatever the deeming rate says. So when deeming rates rise, your assessed income rises, even though not one extra dollar has actually arrived in your account. Now here's the part that makes this calculable, and it's a genuinely useful quirk. Because both deeming rates are rising by exactly the same half a percentage point, you don't need to fuss about which portion of your money sits in which tier. The extra assessed income is simply 0.5% of all your financial assets. That's it. $100,000 in financial assets means $500 a year in extra assessed income. $400,000 means $2,000 a year. It scales in a perfectly straight line. And then the income test does its thing. Above the income-free threshold, your pension reduces by 50 cents for every dollar of assessed income. So half of that extra deemed income comes straight off your payment. Put those two together and you can find the exact crossover point. For a single pensioner, the pension rise is $36.80 a fortnight, which is $956.80 across a year. To lose that much to deeming, you'd need the increase to generate about $1,900 of extra assessed income, because you only lose half of it. 0.5% of what gets you to $1,900? $382,720. That's the line. A single pensioner assessed under the income test with roughly $383,000 or more in financial assets ends up worse off on the 20th of September, not better. For a couple, the same calculation using the $55.60 rise gives a crossover of $578,240 in combined financial assets. Let me put some real numbers on that so you can find yourself on the scale. Take a single pensioner assessed under the income test. With $200,000 in financial assets, the deeming change costs about $19 a fortnight, so against the $36.80 rise, they're still ahead by around $17.50, comfortably better off. At $400,000, the deeming cost is about $38.50, so they're roughly $1.60 behind. Effectively break even, the rise has been entirely cancelled out. At $600,000, the deeming cost is around $57.70, so they're nearly $21 a fortnight worse off than before the increase. And at $800,000, they're down about $40 a fortnight. Same pension increase headline, and that person's payment has gone backwards by more than the increase was worth. Let me run the couple version too, because the numbers land differently and most of the coverage only talks about singles. Take a homeowner couple, both on a part pension, assessed under the income test, with $400,000 in combined financial assets. Their crossover point is $578,000, so they're comfortably below it. The deeming change cost them about $38 a fortnight in assessed income terms, against a combined rise of $55.60. So they come out roughly $17 a fortnight ahead. Now take the same couple with $800,000 in combined financial assets. The deeming change cost them around $77 a fortnight, against the same $55.60 rise, leaving them about $21 a fortnight worse off than they were in August. Identical headline, opposite outcome, and the only variable is how much they have in the bank. There's a genuinely positive flip side worth knowing, and it's the reason to tell somebody who isn't currently getting anything. The cut-off points, the level of income or assets where your payment finally reaches zero, move upward when the maximum rate rises. They have to, because the cut-off is simply where the taper grinds the payment down to nothing, and if the payment starts higher, that point sits further out. So on the 20th of September, the disqualifying limits shift up, and a small group of people who were told they were just over the line become eligible for a part pension. Now, be honest about the interaction. For income-tested people, the deeming increase pushes assessed income up at the same time, so the two effects partly cancel each other. But for anyone who was knocked back on the assets test, there's no deeming counterweight at all. The line simply moved toward them. If you know somebody who was rejected in the last couple of years and has never rechecked, the week after the 20th is a good moment to nudge them. One practical timing point, because this generates confusion every single indexation. The new rates apply from the 20th of September, but age pension is paid fortnightly, and your particular payment cycle determines which payday actually reflects the change. Depending on where your fortnight falls, your first payment at the new rate might not arrive until early October, and some people receive one part rate payment that straddles the change. Every March and September, a wave of people check their account on the 21st, see the old figure, and assume they've been missed. Usually they haven't, it's just the cycle. Give it a full fortnight before you start worrying. Now, the single most important qualification in this entire video, and if you take nothing else, take this. All of that only applies if your pension is currently set by the income test. Remember, there are two tests, assets and income, and Centrelink pays you whichever produces the lower result. If your payment is being determined by the assets test, the deeming change does not touch you at all. Deeming only feeds the income test. So an assets-tested pensioner simply receives the $36.80, and that is the end of the story for them. And that's why the honest headline here isn't everyone loses. Most pensioners are better off on the 20th of September. Anyone on the full pension is better off. Anyone assets tested is better off. Anyone income tested with modest savings is better off. The group that goes backwards is specific and identifiable. Income tested pensioners with large financial holdings. If that's not you, enjoy the increase with a clear conscience. There's a second-order effect worth understanding too, because it explains something people will notice and misread. When deeming rates rise, assessed income rises, which means the income test cut-off point is reached at a lower level of actual wealth than before. In plain terms, the deeming increase can push a small number of people who are receiving a very small part pension off the payment entirely. If you're near the very top of the income test range and your payment vanishes shortly after the 20th, that's the mechanism, not an error, and not something you did. It's also worth being fair about why deeming is going up at all, because this isn't arbitrary. Deeming rates were frozen from 2020 through to March this year, an extraordinarily long freeze, while actual interest rates rose substantially. The rates have been catching up since, in half-point steps. One in September last year, one in March, and now this one. Even after this increase, the upper deeming rate of 3.75% still sits below the Reserve Bank's cash rate. So the argument from the government side is that deeming has been running below what savings genuinely earn, and this narrows a gap that was unusually wide. Whether that feels fair when it's coming out of your fortnightly payment is a separate question. But the trend is clear, and there's no particular reason to assume this is the last one. So what should you actually do? First, work out which test is setting your payment, because it decides whether any of the second half of this video applies to you. Your Centrelink letter or your MyGov account will show the assessment. If your assets tested, you're getting the increase, and that's that. Second, if you are income tested, add up your financial assets, bank accounts, term deposits, shares, managed funds, account-based pensions, and compare that total to the crossover figures, roughly 383,000 for a single, 578,000 combined for a couple. Above those numbers, expect your payment to go down on the 20th despite the headlines, and don't panic when it does. Third, check your statement in the first fortnight after the 20th rather than assuming. And fourth, if the numbers land badly for you, that's the moment to have a proper conversation with a licensed advisor about how your money is held. Because deeming applies to financial assets specifically, and there are legitimate structures that are treated differently. Two honest notes before you go. First, these figures come from the published indexation and deeming announcements for the 20th of September, but your own result depends on your exact balances, your assessment basis and your circumstances, so confirm your specific position with Services Australia or through MyGov, rather than working off any general figure, including the crossover numbers I've calculated here. Second, this is general information, not personal advice. The break-even figures are arithmetic based on the published rates, not a recommendation about what to do with your money, and anything involving restructuring how your assets are held should go to a licensed financial advisor with your real numbers in front of them. So tell me in the comments, are you assets tested or income tested? Most people genuinely don't know, and after the 20th it's going to matter more than usual. Take care, and I'll see you in the next one.